Hi there, how are you today? Today is September 8th, 2020. Hope you had a lovely Labor Day weekend. Beautiful weather here once again. I'm going to be heading out of town for a few days, going up to New Hampshire. I may or may not post a video, but I may post a video of the economy up in New Hampshire. We'll see how New Hampshire's faring. Today we're going to talk about quantitative easing and the impacts of what the Fed is actually doing. It's quite astonishing. I know I referred to it as a magic wand, but I'm going to get into it a little bit more. We have some news that we're going to go over first. U.S. is hemorrhaging $3 billion a week due to the lack of tourism. They call it a tourism crash. It says U.S. loses $3 billion per week in lost tourism dollars, which estimates a total loss for the 2020 year at around $155 billion. A new report from the WTTC. Lack of international visitors to the U.S. due to pandemic could wipe out more than $155 billion from the U.S. economy alone. A loss of $425 million a day. This is that V-shaped recovery that we're all in. Here's another article. It says, grim outlook for small business owners in New York. The survey found that 18% of responding businesses either had no cash or just enough to get by for only 2 weeks or less. Yep, V-shaped recovery. Those small businesses are doing great, aren't they? Back to the tourism. Hilton, Times Square, New York City, closing its doors. Cannot sustain. We all know New York City's a ghost town. Here's another one. Chapel Hill, North Carolina. Jobs are not coming back. All those in that picture are restaurants that no longer exist in Boston, or in the Boston area of Massachusetts. Another article here. It says, another coronavirus package is probably not happening after the job reports. I'm reading some articles that says the new GOP bill is coming out. It does have help for the airlines to prevent this mass wave of layoffs come October 1st. It does not include stimulus. The $1,200 checks, it does not include that. I guess, the government is doing this quantitative easing. Another name for it is the easing of money, or money easing. It's the printing of money. It's just having easy money. The Fed is creating this money, and with the money, they are buying treasury bonds, mortgage-backed security, corporate bonds, a lot of it junk. They're buying these assets on the open market through big banks, right? So you got Wells Fargo and Goldman Sachs and JP Morgan and Bank of America and all these major players in the banking industry that are holding on to all this cash, and the government is holding the debt. And what the banks want to do is loan it out with very low interest rates, right? So the banks are selling these bonds with a lower interest rate, practically 0%, and then the banks are supposed to give this money out to stimulate the economy. And that is why they had all these PPP loans and EIDL and these small business loans, because they wanted to get the money into the hands of Americans to stimulate the economy. So that was their way of easy money, right? So it's not like they printed it. They didn't print the money. It was more of a digital currency that they just credited, on the books, and same with the debt. So now these banks have all these assets, and then what the Fed is doing, it's trying to maintain higher prices. So there's some controversy about what inflation is. Is inflation higher prices, or is inflation the amount of money that's out in a society? I tend to agree with Peter Schiff. Inflation is the volume of money which keeps prices high, right? So if you have a lot of money in the system, the price of everything will stay high, and they can create this inflationary 2% is what Jerome Powell had wanted to do, right? And people aren't spending money anymore. I guess the Fed wants to prevent deflation. And deflation is when the prices dip down, right? They go below. I have a school in Tanzania, spent a lot of months and a year in Tanzania. So Tanzania has no printing of money, right? So what happened is rice used to be 2,200 shillings for a kilogram, which is roughly, let's say, $1. And now the price of rice has gone to 75 cents because people don't have money. They don't have the dollar anymore, the 2,200 shillings, to pay for the rice. So the U.S. government wants to prevent that from happening. So they figure if they can maintain the prices and they can maintain spending at a certain level, it will create more jobs and create a bigger and better economy, which we all know this can totally collapse. And it's not slated to work all the time. So you may ask, when the unemployment rate is so high in this country right now, isn't deflation a good thing, right? So more people with less money can afford the goods and services. Well, some might think yes, but the government thinks no because it's not healthy for stimulating growth. So now that the banks have all this money and they're loaning it out to people, people can borrow the money on larger items, whether it be in the stock market or a house or a car. I mean, that's what they want to do. They want to loan money for big ticket items at low interest rates to stimulate the economy. So what happened is it's working in some areas, right? We're going into a little hyperinflation with houses and people are buying cars. The government, they're trying to control the amount of economic activity that's occurring. That's what the Fed is trying to do. And usually what the Fed does is they invest in short-term assets. So a 1-year treasury bond rather than a 30-year treasury bonds. But what the Fed is doing now is they are buying longer assets, like assets with a maturity date further out, so they can control the yield of which inflation goes. And this is a last-ditch resort to stimulate the economy. I mean, they think that the job rate, when unemployment rate is now 8.4%, which we know is not. There's the real unemployment rate. We're talking 30, 40 million people still out of work. So now that the rate is 0, it can't be manipulated that much anymore, right? There's no room to go down. So if they don't print any more money, that means it's a healthier economy and the economy can slowly rebound on itself. But we know today that without more stimulus, the economy is going to suffer. So we are in a depressed time. We are certainly in a recession. Some will say even a depression. And the only way out of it, if the Fed prints more money. The Fed doesn't buy the bonds from the Fed. The Fed buys them in the open market. And theoretically, it is taxpayer dollars that they're printing out. And they're buying it at really high cost from the open market because they're not treating the Fed fairly because there's a lot of money to be made at all those banks, right? So they are charging top dollar for the Fed to buy back these bonds. There's a fine line between printing too much money and too little money. And the Fed has to be careful of that. The Fed is the steward of our currency and an independent entity from the government. And the quantitative easing, quantitative could be money, easing, easy money. That's what it is. It's just easy money. It's like poof. The Fed's brilliant plan, more inflation and higher prices. Now, an economic downturn that we are most certainly in, and with this pandemic that's slated to expedite again when everyone's back in school, they want to keep prices high. The Fed aims to maintain a price inflation rate of up to 2%. Instead, the Fed will now allow inflation to remain above 2% to balance out periods of lower inflation, so deflation. So they'll let it rise above 2%, providing that it'll come down without the injection of more money. So I think they're trying to hedge, not having to do their little magic wand too often. It is acknowledged that the Fed is unlikely to reverse course and stop increasing the money supply anytime soon. So the money is going to keep being injected into the economy. It says today U.S. household debt and business debt are each over $16 trillion. And the biggest debtor, of course, is the federal government. An increase in rates, anything close to what it should be or could be in a free market, could make it impossible for consumers, businesses, and especially the federal government to manage their debt. See, and this is going to be a problem because people and businesses are taking on way too much debt. The Fed also has dramatically expanded the balance sheet since 2008 via multiple quantitative easing. The Fed is now the world's largest investor and holds about 1/3 of all bonds backed by U.S. home mortgages. Government holds your mortgage. Once the lockdown ends, the Fed's actions may lead to a short-term boom. However, long-term effects will be even more debt. Continued erosion of the average American's standard of living and the collapse of the fiat monetary system and the welfare warfare state. The crisis will likely be brought on by the rejection of the dollar's reserve currency status. And this will be supported by concerns about the stability of the U.S. economy. The question is not if the current system will end. The question is how it will end. And I'm telling you, folks, it's going to end with a lot of unrest, social unrest. We're seeing it unfold already. Look what's happening in Portland. Look what's happening in Kenosha, Wisconsin. They're clashing already. This is the beginning of the deterioration of America as we knew it. It's just a smokescreen. You don't see the injection of money. You don't see what's happening, but the dollar is depleting in value, thus creating higher prices. And that's what the Fed wants, so they can maintain low interest rates without the deflation coming in. All right, folks, stay well. Great to be able to talk to you all again. I hope to do a short, quick video from Lake Winnipesaukee in New Hampshire, where I'm going to spend a couple of days taking stock of what I have. And if you like this content, please subscribe. Please like this video, share it with your friends, and I look forward to talking to you again. If you have any questions or I was misinformed with my whole quantitative easing analogy, feel free to put them in the comments. I look forward to reading all of them. All right, keep the faith.